Good morning, everyone, and welcome to Morpay's webinar on salary sacrifice arrangements. I'm Hannah Booth, Content and Communications Manager here at Morpay. And before we dive into this morning's topic, I will run through a couple of housekeeping items with you. So, in terms of the agenda for this morning, Sybil will start off by explaining how salary sacrifice schemes work and what makes the scheme effective. She'll then discuss some common pitfalls to be aware of before examining the implications for national minimum wage, pensions, and statutory leave. Sybil will then run through electric vehicles as a salary sacrifice and bonus sacrifice schemes. And then finally, Sybil will provide an overview of relevant legislation and case law before we move into our Q&A session. Now, in terms of the Q&A session, you may have noticed that your microphone is on mute, but we do want to hear from you. So please drop your questions into the question panel shown here. We've had a huge response to this webinar, so I imagine that we will have lots of questions. So we'll do our best to answer as many as we can during the session, and then any that we are unable to answer during the session, we will follow up with afterwards. Don't worry if you do face any technical difficulties this morning, because we will be sending everyone a copy of the slides and also a recording of the webinar, so you will have that to refer back to. So if you can just take a moment to familiarise yourselves with the audio settings as displayed here. Before I hand over to Sybil, I'm conscious that we will have people on the webinar this morning that aren't familiar with Morpay, so I'll give a very brief introduction. We provide payroll and HR software, as well as outsourcing services to UK businesses. We've been around since 1966 and have all the accreditations you'd expect. Our promise is to make payroll and HR easy, and this is how we do it. With payroll and HR software that's easy to use, quality outsourcing options, and all of this means worry-free compliance for your businesses. And we're also award-winning. On this slide, you can see some of the industry awards and shortlists we've picked up over the last couple of years. If you'd like to learn more about us, you can simply drop me a message at the end of this session. So that's enough about us. Let's meet today's expert. Now, I'm sure many of you will recognise Sybil if you've attended some of our payroll webinars in the past. Sybil is our Group Product Legislation Manager at the Zellis Group, which includes Morpay, Zellis and Benefex. She's a self-described payroll geek with an obsession for payroll and HR laws, which she uses to advise and educate on everything legislation, both within her team and also externally. She's also an advocate of neurodiversity in the payroll industry. Good morning, Sybil. I'll now hand over to yourself to run through today's session. Thank you.
Thank you very much, Hannah. Good morning to everybody, and thank you for joining me here today. So we'll just sort out going over. So just a quick note before we begin. So caveat to what we can offer you today. I'm going to attempt to try and explain as much as I can salary sacrifice schemes and implications, but what we're not able to do is give specific advice for companies. And this is really just around that it's actually a really, really complex area. There's multiple areas to be looked at. So there's contractual law, there's tax laws. So if you do have a question that is specific to your business, please do go and get the relevant legal advice or tax advice from your external or internal providers. So to start off with, we're going to look at how salary sacrifice works. So what is salary sacrifice? A bit of history for you. This is in essence where the employee sacrifices some of their remuneration in exchange for an employer-provided benefit. It was introduced as a way of employees adding flexibility into their benefits package at no cost to the employer. In an informal state, salary sacrifice has been with us since the 1970s. This was a time where employers couldn't give pay rises due to government policies designed to control huge inflation. So instead, they were given a benefit such as additional pension contributions or more holiday instead of the pay. Although this is not what we know today, it is the beginning of these type of schemes. We obviously still do have pensions and holiday buy schemes as salary sacrifice, but they aren't just being given now. It is in exchange for remuneration. So jumping forward to 2017, the government took measures to ensure that tax revenue was preserved. These benefits increased to a point where employees were funding everything from fridge freezers to wine. This was drawing attention from HMRC, who were concerned about the many employees paying tax, subsidising with a few who sacrificed for things as a classic Merlot was one example, or a 70-inch plasma TV. There was mobile phones, gym membership, and all things like that. Other benefits that they also got rid of in 2017 included car parking, health screening, gadget insurance. But pensions, pension advice, childcare, cycle to work, and ultra-low emission cars were left as acceptable and remained exempt. This is the time they also brought in the opera. Taxable value of the benefit will be the higher of the current value or the cash foregone. And this would be the value used for calculating income tax and Class 1A National Insurance contribution, known as NICs. So you may say, well, we have more salary sacrifice than the 5 that I've listed, but this is where the benefits in kind comes in. So the cost of this may be sacrificed at source, but there may well be a benefit in kind cost attached as well, which just means in essence that it's only actually a national insurance saving for the employee. This is still attractive to employees, but it does not quite offer the same benefits to the business and doesn't offer the tax reduction as well, although they may be less tax than had they have paid the full amount. We won't be looking at childcare voucher schemes today, as I'm sure there's many people here who still may have an employee or two on a legacy scheme. But as it's been closed to new entrants for many years now, I expect everyone who operates this scheme to fully understand it. And just remember, this is employer's law, so unique to every employer, and their contracts and advice needs to be taken through relevant specialists. And this is where the whole picture needs to be taken into account. So this is one of the reasons we can't comment today. So on to the next slide and looking at how the process works. There's considerations that need to be taken into account when looking at schemes. Now, no, we no longer need approval from HMRC to set up a scheme. But what you can still do is ask them to review a scheme once it's up and running. So this is something you may want to do, or if you're actually comfortable in making sure your scheme's running okay, then it's absolutely fine to not engage with them. Consider, how will you be checking for national minimum wage compliance? Will you be actively checking values as each request comes in? Will this be a benefit to most employees, or is it just going to be for high earners? How can you offer employee benefits for those that are paid very close to minimum wage? Processes and policies as well, are they up to date, comprehensive and compliant? Are you accruing budget to cover for statutory leave? Are you able to implement timings for employee change requests? Who will handle contract changes and checks for minimum wage compliance? If the salary sacrifice is effective and if the employee receives a non-cash benefit instead, you should also look to see if the employee has the right to give up the benefit at any time and revert to the original higher cash salary. If they can, the non-cash benefit may be taxable as earnings within Section 62 of ITPA 2003. And there are a couple of employer manuals that have this information in as well. But this is where benefits in kind come in, such as electric vehicles or the employee keeping the bike after the cycle to work bike purchase has been complete. Now, it is a myth that payroll software has to be fully compliant on salary sacrifice, and there isn't even a requirement for software to be able to handle these types of arrangements, but all can. And it's just the way that they do it and your policies and practices that will affect whether the scheme is successful or unsuccessful. On this current slide, I have a very basic example of a employee who has got £50,000 salary a year. and then they choose to pay in £5,000 a year into the workplace pension scheme. So the employees, in essence, sacrifice £5,000, and the new contract will list a £45,000 salary. The payslip will have the taxable pay on the lower amount there. So let's go over to the next slide and look at key rules. On this slide, you will see just some of the high-level considerations needed when deciding on a new scheme. You cannot reduce the employee salary below minimum wage, and we will look at this a bit more later on. The contract must be correct and in place before reducing the salary through the payroll, and we're going to look at this again within this webinar. So what makes a scheme successful? Do we need to have HMRC approval? As I said, you don't. And HMRC do not give advice on salary sacrifice arrangements before they've been implemented. There's no requirement, as I said, for employers to inform HMRC that they've adopted a sacrifice agreement. If there is a point of legal uncertainty, you can contact HMRC clearance team, and HMRC may agree that changes to the employment terms and conditions affect the employee's entitlement to earnings for tax and NIC purposes. Agreements is given on the understanding it will cease to apply if there are further changes to the contract. So the following aspects should be considered when deciding if a scheme is effective or successful. So what is the date of the change of the remuneration package? Changes cannot be retrospective. Has the employee's contract entitlement to cash been reduced and replaced with a benefit? Is there a right within the contract to return to the original remuneration package? What conditions, if any, have been met in order to return to the original remuneration package? Is the benefit exempt from charges to income tax or just exempt under the benefits code? Does it provide a benefit does the provided benefit satisfy the conditions for exemption from tax and/or national insurance? Has the scheme been implemented? Is the correct amount of tax and NICs being accounted for? NMW national minimum wage is a consideration. The cash wage should not fall below a set figure, and apart from living accommodation, benefits in kind do not count towards minimum wage, and it makes no difference whether or not the benefit is taxed. This section here is really important. If the scheme is not successful, then you will have a tax liability and the original higher amount and the contractual obligation to still provide the benefit. If the employer gets it wrong, it would mean that you are unwittingly undertaxing your employees. Now, the contract is extremely important, and HMRC will look at the contract if they're doing a tax investigation and looking into salary sacrifice. I will speak about timing at the end of this section as it's hugely important. You need to make sure that the contract is signed and not just issued, or that you've actually done nothing at all. It can be a contract amendment, so don't worry about having to send a huge document out each time. When running any employee scheme, you must make sure that you give clear rules for the scheme and to the employees so that they are aware of their obligations and also any considerations they may need to take into account. As you all know, salary sacrifice will reduce the statutory pay entitlement and could reduce your employees' earnings below the lower earnings limit, say if they are part-time workers, even if their hourly rate is reasonably high. Now, it is actually a myth that the employer cannot deny a salary sacrifice request before the contract's changed. In fact, this should be a consideration for the employer if the employee would breach minimum wage. They can say no or suggest a lower amount to be sacrificed. The only quirk on this is for pensions, as you cannot part run a salary sacrifice and part run a deduction such as RAS or net pay deductions. So if you have the basic auto-enrolment amount, you'd need to consider declining the salary sacrifice as a whole request and then processing their tax-free elements as a standard pension scheme. Entitlements to cash. So this concerns the true construction of the revised contractual agreement between the employer and the employee. When the employee and the employer have changed the remuneration package, they will have achieved one of the following results. They may have genuinely reduced the employee's entitlement to the salary in exchange for a benefit, and that's having a successful sacrifice. Or they may have continued the employee's entitlement to the original level of cash remuneration. Under the new arrangement, the employee is merely asking for the employer to apply part of the cash remuneration on the employee's behalf, providing a benefit of the example. And this is actually when it's not a successful scheme. HMRC in one of their manual pages does say that salary sacrifice is a matter of agreement between the employer and the employee. The role of HMRC is to consider whether the arrangement is effective and tax and NICs which follow from this agreement. If the employer requests advice in organising a sacrifice, HMRC will explain that this is a matter between the business and the employee, and they will not give advice on terms and conditions in the employer's contract. That's where employment contract law will come in. I'm going to explain what money's worth is now quite early on as well, because you will hear that term. The most common way an employee can turn a benefit in kind into money is by selling it, but that's not the only way. The employee may be able to rent, hire, or give the benefit to other people. They may have the right also at any time to give up the benefit altogether in return for a higher cash wage or salary. So if your contract says you can opt out at any point and opt back in at any point, it's actually making it money's worth. But why is this relevant? Well, the amount being taxable is under Section 62, that the amount of the wages or the salary would be paid in lieu of the benefit. The benefit is still a benefit in kind though as well, and if it's not a cash payment, the employer is not obliged to operate PAYE. So how does the benefit code fit in? An employee may benefit from their employment by receiving a benefit that does not take the form of money, so such as profit share, and that may also be cast as benefit in kind. Some benefits in kind also count as earnings within the ITPA. Others may be treated as earnings under the benefits code. In most cases, the benefits code only applies to benefits that are not otherwise chargeable to tax. So if a benefit is fully taxable under Section 62, because it represents money's worth, the benefit code would not apply. That is a lot for everybody to take in. So as we said, Hannah said at the beginning, this is recorded so that you can go back and listen to it. So we're going to move on to the next slide now. Under contractual law and employment law, the terms and conditions of an employment contract may be varied as often as the parties to that contract, that is, the employee and the employer, choose. A contract can be legally effective for a stated period of time. HMRC's interest in this part of the contract is regarding tax and NIC consequences of that contract. It's only the employee that can make the choice to sacrifice part of their remuneration for a benefit, such as medical insurance, pensions, or anything else. The employer is not allowed to influence this, and only the salary sacrifice item that the employer is able to write in the contractual removal is childcare. The courts allowed this as long as the contract was explicit. Before the employee joined the now old childcare voucher scheme, this case was applied to that I'll actually tell you about later on, is the woman went on to mat leave and the contract was explicit enough that she could be removed from the sacrifice scheme to take it as a net pay deduction. But as I say, this is only childcare vouchers, this is nothing else. It meant that the scheme was not a true employer benefit. So even though an employment contract has been effectively changed in terms of the contract and employment law, it is possible that certain factors within the contract may have unintended consequences for tax and national insurance treatment of elements of the remuneration package. The contract may specify a salary and the provision of benefits. It is common for the benefits in salary sacrifice arrangements to have advantages of tax and NICs treatment. The remuneration packages may be designed to exploit statutory advantage. However, it's also the employee able to give up the benefit at any time and return to the non-cash amount. So this is the money's worth to whether it becomes taxable. The employee would actually therefore be liable to tax at the higher cash salary and still go and then have the benefit as well. Right to revert here is hugely important. It's alongside the contracts in making a scheme successful, so you need to make sure you fully understand and make sure you don't inadvertently make this salary sacrifice scheme unsuccessful due to wording in the contract. This right to revert can be derived from contractual wording and also employee or employer actions. And there is another tribunal case I'll mention later on. While we're here on this particular slide, I want to look at payslip information. If a reduced salary or wages are payable, then these changes should be reflected on the payslip. However, if you ask to see a post-sacrifice payslip, you may see that the figure of the gross original remuneration on the payslip is unaltered. This does not automatically mean that the salary sacrifice is ineffective. The employment contract has been effectively varied and the employee's entitlement to remuneration has changed. The contractual agreement is evidence of the change and the figures on the payslip do not invalidate that. However, if there's no signed agreement, then it is reasonable to consider all information. The payslip is one of the pieces of evidence that will help establish whether changes have been properly made. HMRC in their employment manuals do say that they became aware, this was a few years ago, that payslips continue to show the pre-sacrifice level of gross salary as gross pay. The sacrificed amount then is shown as a deduction on the payslip after this amount, and that is then made before the PAYE and NICS deductions are applied. This format gives the impression the employee is entitled to the former higher level of salary and has simply applied a sum to reimburse the employer for a provision of benefit. But HMRC spoke to many representatives of payroll managers. They made the case that most payroll software can only hold one number field in gross pay. In a salary sacrifice situation, more than one value is often required. So a lower figure to calculate the basic wage and salary, and a higher figure to calculate things such as overtime and holiday pay, etc. They agreed that where the employment contract has been effectively varied and the format of the payslip will not be used to challenge the effectiveness of the agreement. However, as noted above, if the contract has not been changed, the format of the payslip is one piece of evidence that they would use on how to base their views. So they have agreed that on your payslip you can show, say, salary of £2,000 and then minus £200. You don't have to show the salary as being £1,800. On to the next slide. We're going to have, this slide shows this side follows the right to revert and contracts quite well. As if you have a right to revert, then the tax savings will not be applicable. Also remember that tax and national insurance have separate legislations and different rules. So there may be a entitlement to not have tax taken from a certain amount of money depending on what it's for, such as pensions. But then they will still have a nickable implication. Some items may never have tax liability even outside of the salary sacrifice scheme. So if the scheme was unsuccessful, the benefit could still have no tax liability, but then have a national insurance liability. As the employment world is ever changing and also compliance is so much more at the forefront, you should be reviewing your policies and procedures and practices regularly and ensure that those who are making decisions on anything to do with salary sacrifice have full training and understanding of all areas before they make changes. Next slide is onto documents and timing. Although timing is quite late in this section, don't let that influence the importance of it. It is in fact one of the most important areas to consider, and most unsuccessful schemes are failing due to timing. First consideration concerning the timing of changes to the employment contract. Entitlement to future remuneration must be given up before it can be treated and received for employment income purposes. Once earnings have been received for employment income purposes, they are taxable even if the payment is not paid over. There is an employment manual, EIM 42705, and from there onwards that explains this. So in practice, this means that the employee who is entering into a salary sacrifice arrangement must agree to the vary of the employment contract well in advance of the date when the first payment is due to be made and in advance of the period that that payment date sits. If the contractual changes have not been completed by the pay period that you are going to start taking it from, then the previous contract terms continue to be enforced. The employee is still entitled to receive the benefit, but they are also classed as being entitled to receive the higher remuneration amount and therefore is taxable on the previous higher salary, even though the smaller post-sacrifice amount is actually paid. You have to give up the right to that remuneration before it's being treated as received. New contracts must have been agreed and signed before the period it will become effective in. And if it's not in place before, so that in the previous pay period, the employee is still entitled to receive the high amount of pay, therefore tax and NI is still due. So you'd be inadvertently, if you didn't get your timing right, inadvertently putting your employee to having a higher tax liability, even though they're not receiving that cash amount. On to some common pitfalls. So what could go wrong? There is so much that can go wrong if you don't understand the rules. The biggest ones I've seen over the years in payroll were no contractual changes and timing being mismanaged. The employer would action the change as soon as the notification came in. This was especially so for the employers who use pension provider portals for employees to request changes to go through. They wouldn't issue a contract change and get it signed as well, but they'd still action it. So for cycle to work, the employee would request it, they'd be notified the employees request it, and they would go and make the deduction in that first available pay period. But they wouldn't have sent a contractual letter change through. Or for pensions, so you'd have your notification from your portal, say on the 15th of the month. You'd go and put it in then that month to action. But this makes it unsuccessful due to timing. So some common reasons a scheme would not be successful and therefore tax is due on the high amount, pre-sacrificed amount. Sacrifice amount is requested and sacrificed in the same period. Contractual change is not requested and issued at least one pay period in advance. A contractual change is issued but does not specify the amount that is being sacrificed. The scheme is regularly being changed and the employee or the employer moves the employee in and out of a sacrifice scheme on a regular basis, giving money's worth. And no change to the contract has been made. The employee just sends an email making the request. There may on that particular point be some nick relief, but the employee would have to be taxed at least at the higher rate, and you'd have to assess the Social Securities Act to whether there's nickable pay on it. HMRC do state that where a salary successful is not example, the employee continues to be taxed under Section 62 on the higher level of the cash remuneration, and the employee is also still entitled to receiving that benefit. It's also worth noting that national minimum wage may be a reason that a scheme could become unsuccessful inadvertently because the employer, depending on what and how the breach is managed within the terms of the scheme. National minimum wage breach does not make a scheme unsuccessful on its own. It's what happens from there on after, or even in that pay period, that will determine whether the scheme's unsuccessful. HMRC are extremely vocal in this area at the moment, and it's one of the easiest areas for them to target on a check, which could then trigger a full compliance check. So we have a couple of examples on the next slide of unsuccessful schemes. The employee, example one, the employee has a request to join your Circle to Work scheme on the 27th of May via your supplier. You receive notification from them on the 3rd of June and put them onto the June payroll to start the deduction. Your HR team writes to them to accept their application. This is unsuccessful. There's no signed contract. And the contract could only then be signed, as example 2, on timing. So the employee is requested to join your cycle to work scheme on the 27th of May via supplier. You received notification on the 3rd of June and put them into the June payroll. Your HR team sends the contract amendment letter to the employee on the 30th of May and receive it back on the 2nd of June. That's unsuccessful because the contract amendment is actually in the same pay period. Example 3, the employee has requested to join your cycle to work scheme on the 27th of May via your supplier. You received notification on the 3rd of June and put them into the July payroll to start the deductions. Your HR team sent a contract employment letter to the employee on the 30th of May, which you received back signed on the 2nd of June. In August, the employee breaches minimum wage, so the employer moves the deduction to net pay and back to gross pay then in September. And this happens again then October and November. The initial scheme up until August was actually successful, but thereon after it becomes unsuccessful. Therefore, the employee has liability from day one of the scheme starting. The employer has made the decision, so it must be the employee that makes the decision, and in life-changing situations only, not just as and when it's appropriate. No contract changes were made, even if the employee did request to leave the scheme and return the bike. So minimum wage. We're going to go over and have a look at minimum wage because I'm conscious that there's an awful lot to get through and very little time. So minimum wage and salary sacrifice are completely separate legislations, but have such close ties. These ties are becoming much more commonly associated as HMRC have ramped up compliance. It's one of the main reasons for non-compliance in the name or shame lists, which are the lists that are found in the employer educational bulletins. This time round, there was 178 employers in the section that included salary sacrifice. And it's a big area that they're looking at for salaried employees who are on salaries of £25,000 to £50,000 a year. National minimum wage does not mention gross or net pay at all. It mentions pay. Salary sacrifice reduces contractual pay, thus the amount of pay that can be counted towards minimum wage. It's also worth flagging here that a salary sacrifice scheme could become own use on benefit for minimum wage purposes if the employer was unable to action the sacrifice scheme in its true form due to a minimum wage breach. And instead of the employer taking the costs themselves away from the payroll, the employee contributes in a different way. There is a employer manual NMWM 09300 that has more information. As an employer, you cannot just change the contract to say if the employee goes below minimum wage. As a part of your employer duties, you must assess the employee before agreeing to contractual changes initially. If the employee wants to change role or reduce hours, that would initiate a breach, then you as the employer, as part of that contract change, can work with your employee to negate that risk or remove them permanently from the scheme. Next slide has a bit of guidance from HMRC. But the salary sacrifice legislations are very clear that it is only the employee that can make the choice to sacrifice a part of their remuneration for a benefit. It is only the employee that can choose to leave the scheme. The employee can only change their sacrifice agreement should they wish to if the following applies. The employer must alter their contract to reflect the change. It's got to be, as I said previously, one pay period before the change takes place. And most importantly, the employee must have a significant lifestyle change that alters their financial circumstances, and they say this is such as marriage, divorce, partner becoming pregnant or made redundant. At no point can the employer be allowed to ask the employee or influence the employee to make changes to the sacrifice scheme. At the very end of this webinar, we do have some slides with lots of links for today, and in there is a link to HMRC's webinar on minimum wage. But within that particular webinar, there was a question that came up, every other question, I think it was near enough, that said, if an employee pays for their pension via salary sacrifice and their gross pay is usually above minimum wage, if they, for example, had their pay reduced through sickness for 1 month, or a reason to take them below minimum wage, would they need to pay their employee contributions via net deduction for that month? HMRC's answer is very black and white. NMW does not recognise a difference between gross and net pay. Any deduction from pay outside of a very specific list of exceptions is likely to reduce a worker's minimum wage pay. A salary sacrifice will always reduce minimum wage pay. There are no exemptions. Any determination would depend on the arrangements in place. So next over to salary sacrifice and pensions. There are slightly different rules for pensions regarding successful and unsuccessful schemes, and this is for payments made to a registered pension scheme. HMRC Employment Manual states where the pension contributions are involved, the income tax liability of the employee will often not be affected whether or not the salary sacrifice succeeds. If the salary sacrifice does not succeed, the pension contribution will be treated as an employee contribution, because remember, salary sacrifice is an employer contribution in exchange for you completing work. So the employee would get the full tax relief at his or her top rate of tax on the contribution. This is the same overall income tax liability as if the salary sacrifice had succeeded. For income tax effects on salary sacrifice, there is an EIM manual that you can see. But remember, this is the tax side of it. This is not the national insurance side. So for the scheme to not become successful, there will be other consequences as well as tax. Do consider that if you move your contributions, your employees' contributions out of salary sacrifice for any region, we usually see employees for minimum wage breaches, you must process it via the scheme method, so relief at source or net pay. Otherwise, the employee will need to complete a self-assessment to claim the tax relief, and you will need to advise them at the end of the year the amount you did not process under the pension scheme rules. But there's also a risk HMRC could see that as money's own use and benefit and take it into account in deductions and benefits in kind. Pension contributions are exempt from NMW purposes, even if they're processed as RAS or net pay. But a word of caution, by moving an employee out of the pension self-sac scheme due to NMW, this would still make the scheme unsuccessful, and the liability would then come on national insurance. Now, if the salary sacrifice scheme is successful, as we know, it reduces class 1 liability, national insurance liability. And this outcome arises because NICs will be payable only on the reduced salary. NICs will not be payable on the employer contributions to the approved pension scheme, as these contributions are specifically disregarded by virtue of paragraph 2, part 6, schedule 3 to Social Security Contributions Regulations 2001 Act. The NICs savings will equate to the NICs originally due on the amount sacrificed. Legal advice has confirmed that smart pension schemes can be effective in reducing NIC liability of the operating employer and employees who decide to participate, and that again is from HMRC's manuals. Now, since the employees do not have to sign the documents signifying their acceptance of a revised terms and conditions of employment, does this mean that the contract's not been varied? This is for pensions only. If the basic salary continues to be used to determine things like overtime pay, does this indicate that the cash has not actually been reduced? In the NIM manuals, they call pension schemes used under auto enrolment smart pension schemes. That is then operated under salary sacrifice. Since the employees do not have to sign documents signifying their acceptance of the revised terms, HMRC say that the contract, does this mean the contract's not been varied? They say no, the scheme is clearly intended to vary the terms and conditions of employment of all employees except those who opt out. This is made known to all employees in advance of the scheme being introduced. The fact that those employees who do not opt out accept the payment of the reduced salary without objection means that they have accepted variation to their contract by their conduct. So this just means that within pensions, you do not have to go and get them to sign a new contract if they go and say increase their percentage, and you've accepted that because it's not going to breach. So if they've say decided to go from 5% to 10% employee contribution, this part of the National Insurance Manual means that you do not have to get the signed contract. They would deem that, but only again on pensions. The other question, if the base salary continues to be used to determine things like overtime pay, does this indicate that the cash salary has not been reduced? As I've said before on the pay slips, no, using the base salary such as purposes is not incompatible with there being a genuine reduction in the employee's contract pay. It is, however, important in all cases to check the scheme's been properly implemented so that you give effective and varied terms and conditions of employment, such as checking the necessary changes have been made to the rules of the pension scheme to reflect the cessation of the employee's contributions and the increase in the employer contributions. It should also be confirmed that changes are reflected in the employee's wage slips, PAYE records, etc. Now, just an interesting note, well, I find it interesting. Since writing this, HMRC have published a report on bringing pensions out of salary sacrifice altogether, or maybe just allowing a small amount of relief. We have got a link at the end of this webinar for you to have a read of that, because that's very interesting. Over on statutory leave. When on statutory leave, the parent cannot be worse off than when they were in work. The benefit has been contractually changed to be an employer provided benefit, and the parent is therefore legally entitled to this while they're off. You cannot make salary sacrifice deductions from statutory payment. This does not mean that you can switch to take it from net pay either. Social Security legislation provides that an employer pension contribution should be continued during the occupational maternity leave and any period of additional maternity leave, calculating using the same pay and contribution rate as the employee would have received had they not been on maternity leave. Where there's no salary sacrifice in place, any matching employees' contributions no need to be based on the pay they received at the time. However, salary sacrifice pension arrangements changes this because they have the effect of converting the employee's contribution into an employer contribution. This means that the full amount needs to be paid irrespective of what pay the employee receives at the time. Most other salary sacrifice would have to be continued throughout the leave as well. As I said before, childcare vouchers are the only possible exemption, but only if the contract is very specific and in line with the Peninsula Court case. The next slide is just really a quick slide for your reference, so we'll go past this quite quick. It's just a few examples that give good practice and examples of common failure. Although failure to maintain NMW does not make a scheme unsuccessful, it does cause the employer to fail in their legal obligations. I want to now look at why electric vehicles via salary sacrifice. So electric vehicle salary sacrifice has grown in popularity over the last few years due to the low tax benefit in kind, making it a popular choice for employees to access electric vehicles for their own use. This allows them, in essence, to lease the car and save on national insurance, and some may also have some tax savings as well. There's also the obvious employer benefits. Not as all salary sacrifice schemes, it isn't a benefit that the employees can benefit from. Such a sacrifice amount tends to be a lot higher than pension contributions, private medical or holiday purchase schemes. So this may be only available to higher earnings, for higher earners. So next slide has got basics on how it will work as an electric vehicle. In essence, the salary sacrifice part is the lease payment, that is the monthly payment, and it is exactly the same in any salary sacrifice scheme. The contract is changed before the payment commences and the employee is assessed for minimum wage. The car is actually owned at all times by the company though. This is because the company is providing the car to the employee in exchange for work done, and the payment is made from the employee to the employer before it goes to the lease company. The scheme is set up as a normal salary sacrifice scheme. And if the employee cannot make the salary sacrifice contribution, then the employer will have to cover it, such as periods of statutory leave. Now, the added complication to this scheme is that the company, in essence, owns the vehicle, and therefore it becomes taxable under the benefits code. As electric vehicles are company cars, the BIC also needs setting up separately. Do not make the mistake where you think that you can set up one pay element and go and put NIC relief and tax it. You need to set it up separately, because during the BIC it needs reporting on your RTI, or unless you're still on P11Ds. You've still got to treat these, when setting it up, you've still got to treat these as two different areas. So first of all, set up your salary sacrifice scheme and then process the vehicle as a company vehicle. Now, it is a myth that lease providers report the benefit to HMRC or that the employee owns the car. The employer will have to pay Class 1A NICs and ensure that the tax is appropriately done. Electric vehicles are a very popular choice for both employers and employees. HMRC have received a lot of questions on this topic within their community forums, which unfortunately they are actually closing down at the end of this month. One of the queries states, there would be a taxable benefit which would be captured on a P11D. To clarify, the point about salary sacrifice not decreasing the benefit charge is because no tax has been paid on the salary sacrifice amount, because the individual has given up the right to this money. The only way the benefit charge can be reduced by an employee is to use their taxed income, so their net pay, to actually pay for the vehicle. Now, tax on electric vehicles as a benefit is very low. This means that savings for an employee can still amount to a fair figure. On to bonus sacrifice. How do these work? Employees can agree to sacrifice a contractual bonus, but something here is really key is the timing. It can be a lot more tricky for bonuses. So what we've done is, on the next slide, we've done a little example to try and explain it a little bit better for you. So over to the next slide, thanks. So on this slide, your sales manager is contractually entitled to a bonus each year. The amount of the bonus is based on profits of the employing company. The company's year end is the 31st of March. Accounts for the year are finalised on the 30th of September, enabling the amount of the bonus to be calculated. The employee is not entitled to the payment of the bonus until the 31st of December. So the employee is informed on the 31st of October that the bonus will be £5,000. The letter informing the employee of the bonus asks the employee to choose between receiving the bonus or giving up his contractual rights to the bonus in return for the company making a £5,000 employer's contribution to a registered pension scheme for his benefit. The employee chooses the second option and returns the completed documentation and has signed it to this effect before the 31st of October. The completed document makes it clear that the employee has given up his contractual rights to the bonus based on the company's profits for the year ending 31st of March, and he does not have the right to change his mind on this decision. This can be a very common salary sacrifice type, but I've seen many employers not following HMRC guidance and the legislation, inadvertently making the scheme unsuccessful. This type of scheme brings its own peculiarities. It must be sacrificed before it's treated as received, or remuneration is classed as being received when the payment's made, or, if earlier, when the employee is entitled to receive it. For example, the employee may be entitled to receive a payment on the 1st of April, but it's not processed until the 31st of May because of misnotification to the payroll team. This is still being deemed to be received on the 1st of April. So for the sacrifice to be successful, if that happened, the employee must have returned a completed signed documentation before the 31st of March. If they returned the documentation in April, then the scheme's not successful and they still have to be taxed at the higher rates. So the next slide is on documentation requirements and compliance risks. These are just some of the helpful things to help you with the bonus on the bonus scheme. We're going to quickly flip over now onto case law because I'm really running behind, but you'll be able to have a look and read at this when you receive the slides afterwards. So we have tax, social security, contractual and national minimum wage laws to contend with for salary sacrifice. Case law is just a question of application of these laws, and employees can take employers to court whilst they're still employed for things such as breach of contract or underpaid minimum wage. Case law doesn't change the laws, all they do is tell us how they are to be applied or interpreted. On the next slide, we have 3 specific salary sacrifice case laws. So the need for care when structuring a salary sacrifice arrangement was brought out in the case of Heaton Bell, a case heard at the time when the tax payable on the company cars were very low. An employee had agreed to a reduction in his salary for a fixed amount in return for being able to borrow a car from his employer, which in today's term is still having a company car. He had the option at any time to give up the use of the car and have his salary restored to previous level. This went to the House of Lords, and it was held that he should be taxed on the higher gross amount of the salary, whether he opted for the car or the full amount of salary. HMRC state in Heaton Bell, an employee was provided with the use of a car by his employer. An agreed sum was deducted from his wage for that use. He could give it up any point for the use of the car, with the result that the wage he received would be increased. It was held the use of the car was an emolument or earnings chargeable under what is now section 62. So basically it could be turned into money's worth by surrendering. Reed employment. There was a point here that was raised in the first tier tribunal on a decision of Reed Employment PLC versus Oars. This case concerned travel and subsistence payments made to temporary workers under what was purported to be a salary sacrifice arrangement. The arrangement was intended to take advantage of tax exemption for travel to a temporary workplace. The tribunal found that there was no salary sacrifice arrangement in place as the employees had not sacrificed any of their salaries. In reality, they were paid their salary in full, and even the figures on the pay slip indicated they received a combination of salary and travel and subsistence payment. And childcare vouchers, I've already mentioned this. This was Peninsula Donaldson. Childcare vouchers were provided under a salary sacrifice scheme, are part of remuneration. And so it is not sex discrimination if employer does not provide them at all during maternity leave. This decision seems to be based on a misunderstanding of how salary sacrifice affects contractual pay and should be treated with caution, not least because potentially it may result in HMRC arguing that the salary sacrifice arrangements were not implemented correctly. At the time of the Peninsula case, HMRC indicated that they would issue guidance for employers on this matter, but I've still not been able to find any more guidance than there's in the NIM manuals. Finally, key legislation and guidance. These are just a couple of key areas pulled out for today on the legislation slide, on the legislation side. On the next slide, you'll find also plenty of useful links of a lot of stuff I've talked about today, most from HMRC's EIM manual, a couple from the NIM, which is National Insurance Manual, also a link to the recording. Thank you. That's it from me. Sorry it's taken so long. There is an awful lot to cover today.
Thank you, Sybil. I know there was an awful lot of ground to cover, and I'm sure everyone has found that really useful. Because we are nearly out of time, what I am proposing is that rather than trying to rush through the questions now, what we'll do is we'll create a Q&A document that we'll share. It will most likely be tomorrow when we share it, and at least then everybody's got an overview of all the questions and answers, and they can also refer back to it. So what we'll do is we will send you a copy of the slides and a recording today so that you've got that immediately to refer to, and then tomorrow we'll follow up with the Q&A. I hope that you've all found the session useful today. As always, we've got our Knowledge Centre on the website where you can also refer to for more information. And if you do want to find out more about our software and services, there will be a poll that comes up when you leave the webinar, and you can complete your details here, and then one of my colleagues will be able to contact you. So we will close off the session for now. Sybil, thank you very much for such a comprehensive overview of salary sacrifice and its complexities. Like I say, we'll be following up with the slides, recording, and also the Q&A. So thank you to everybody that did ask a question, and we will be following up on those. So I will now close the webinar. Thank you for joining, and thank you very much to Sybil.
Thanks, everyone.